Hi, I'm Dan Newton, and welcome to DeRiga University. We're so happy that you're here. Our goal is to make business concepts fun and easy using the power of animation. Today, for all our small business news you can use, we have my friend Julie DeRiga, who's a North Carolina certified public accountant, to tell us all the basic information you'll need to know about different business structures.
Thanks so much, Dan. Thank you so much for being here today. Today we're going to talk about business structures, which is the cornerstone of any business. This is one of the most important decisions that you will make as you start and run your own business. So let's talk today about some of the different structures that the Internal Revenue Service offers to us as choices in a for-profit setting. Choosing an entity status directly impacts how you pay yourself and how you pay your taxes. In this class, we will only cover federal topics. Your state may have additional requirements, so always be sure to check with your state and local agencies. The IRS allows three basic structures: a sole proprietorship, a partnership, or as a corporation, either as a C corporation or as an S corporation. Let's start with the simplest business structure available, the sole proprietorship. Think of this as a solitary island all by itself. The sole proprietorship has no real legal protection, with the exception of any professional liability insurance you may have. The first and most important rule is you must be in this business to make money. In other words, a hobby is not considered a business because our main goal as a hobby is enjoyment and not to make money. Photographers, people with horses, and woodworkers tend to have a higher audit risk because those businesses can be confused with hobbies. When you run your business as a sole proprietor, you are required to fill out a form that the IRS calls a Schedule C or Schedule C-EZ. We will discuss Schedule C-EZ in a few minutes, but to make this easier for now, I will only discuss Schedule C. The Schedule C is the form which gives the IRS the financial details on your business. The 1040 is the tax form that the IRS requires us to fill out to report on our personal tax situation. You must use Form 1040 if you are operating or involved with a business. You can have employees, but only one owner for a sole proprietorship. However, if you are married and both people in the marriage are running the business, in this case, you can still file as a sole proprietorship. See your tax professional for the specifics if this is your situation. Also, one person can have many different businesses. For example, if you have a bookstore and a barbershop, then you will need two Schedule Cs. Remember, a Schedule C is what we use to report to the IRS the profits or losses of our business. On a really basic level, it means we take all of our income. And income is defined as anything of value that your business receives for the goods or services that you have sold. And from our income that we have generated, we take away all of our expenses. In business, expenses are defined as any money that you've spent that was ordinary and necessary for the growth or continuation of your business. So, when we subtract our expenses from our income, we then come up with what the IRS calls our net profit or our net loss. Let's take a look at this. We generated $100 in sales, and we spent $50. We then have a profit of $50. If we generated $50 in sales and $100 in expenses, we would have a loss of $50. To demonstrate the movement of profits and losses between the different tax forms, we will use a profit and loss car. In this case, $50, either as a loss or as a profit, jumps on the profit-loss car. The profit-loss car jumps over from the Schedule C island onto the 1040 island. It doesn't require a bridge. It doesn't have very far to go. Just a small leap from the Schedule C island to land on the 1040 island on line 12. If your car is a profit car, this profit adds to your taxable income. So just because you did not bring those profits home with you, you will still have to pay taxes on those profits. Don't let this surprise you. In a sole proprietorship, you may have to pay income taxes. But if you have profits, you will absolutely be required to pay self-employment taxes on your profits. If your car is a loss car, then this will reduce all of your other taxable income that you may have on the front of your 1040. Remember, the self-employment tax is not the same as income taxes. As a sole proprietor, you are required to file 4 times a year the Form 1040-ES. The 1040-ES is the form we use to pay our self-employment taxes. These payments are tough because you must be psychic and be able to predict what your income is going to be evenly throughout the year. If you don't make your estimated quarterlies in a timely manner, you will be penalized. You may want to see a tax professional for some help with the calculation of your 1040-ES, but I just wanted you to be aware of the filing requirement. The due dates for these estimated quarterly payments are April 15th, June 15th, September 15th, and January 15th. As promised, here are the details on the Schedule C-EZ. A Schedule C-EZ is simpler to fill out than a Schedule C. You may be eligible to file a Schedule C-EZ if you have received under $25,000 in cash, your expenses are under $5,000, you have no inventory, no employees, you have a cash method of accounting, no losses, no depreciation, or any Section 179 write-offs. All the rest is the same if you file a Schedule C-EZ or a Schedule C, but I just wanted you to be aware of this as an option. The profit loss car still jumps to line 12 on the 1040 whether or not you file your Schedule C or C-EZ. Your 1040 and Schedule C are due on April 15th. So what do you do if you want to have additional owners or additional investors? You do have other choices. The next entity up from a sole proprietorship is a partnership. You must always have one general partner in any kind of partnership. The other criteria for a partnership is that it must be an ongoing business. For example, if you are buying and selling one piece of property, then this would qualify as a joint venture and not as a partnership. Partnerships are very similar to a sole proprietorship in many ways. Like a sole proprietorship, a partner in a partnership is required to file a 1040-ES. You are not an employee within your company. The filing dates for a partnership are the same as they are for a sole proprietorship, but here are the dates again for you to review. Remember, be very careful about how you structure your partnership agreement with your business partners. The IRS has very specific rules about how you structure the division of profits and losses. The IRS assumes that you are a 50-50 partnership unless your partnership agreement states otherwise. A partnership is a very flexible entity which requires a partnership agreement that accounts for best and worst case scenarios. Also remember that each general partner is personally liable for all the debts and liabilities of the business and not just your proportionate share. What does that mean? It means that if you are a 50-50 owner in a business and your partner goes and buys a Cadillac in the business name, you are 100% liable for the full amount owed on the Cadillac. A partnership is a flow-through entity. What does that mean? A flow-through entity means the entity itself doesn't pay any taxes. The IRS requires partnerships to fill out Form 1065. One of the important parts of this tax form is a schedule within the 1065 called Schedule K-1. The K-1 tells the IRS what each owner's share of the profits or losses are in the business. We'll use an example of the bridge to help us understand Form K-1. Going back to our example of the island, think of the partnership as an island as well. So, if we have $10,000 in profit and our carefully crafted operating agreement says that profits are split 50-50, our $10,000 profit car splits in two and the car stops at the K-1 bridge. The K-1 bridge is the bridge that carries our profit car over to the 1040 island. Our profit car that has traveled on the K-1 bridge is $5,000 and lands on the 1040 island on line 17 because this is our share of the $10,000. In this example, our business partner's car will carry the other $5,000 over to their 1040 island. When it comes to the profits and losses and setting up your partnership agreement, you must have a professional help with this because there are many complexities that go along with the allocations, tax brackets, distributive shares that are very specific to an individual's tax situation. The partnership return 1065 is due April 15th. As I said earlier, the partnership rules are so complex that if you are planning to start a partnership, please seek help with the operating agreement. Make sure the attorney who is drafting the agreement is fully aware of both your personal tax situation as well as the business tax situation. What do you do if you don't want to deal with the complex tax laws of a partnership, but you do want to have partners or investors? Well, an S corporation might be a good entity for you. Let's take a look at this. Because a small business owner's success is directly tied to a company's success, many owners choose to become S corporations. To become an S corporation, you must fill out IRS Form 2553 within 2 months and 15 days of incorporating. You can make the change later, but it's much easier to become an S corporation right from the start. Like a partnership, an S corporation is a flow-through entity. The form that the IRS requires from an S corporation entity is called the 1120-S. The 1120-S is due on March 15th. Just like the partnership entity, the S corporation has a Form K-1. Even if there is only one owner, you will still have a K-1 form. We'll imagine an S corporation as its own island, which we will call the 1120-S island. The 1120-S doesn't pay its own taxes because of its flow-through entity status, but profits and losses jump onto the profit and loss car and travel onto the K-1 bridge and then to the 1040 island to land on line 17. The company profits or losses are a line item on your return, along with other ways you bring in income, say through personal investments like stocks or any other wages and income you may have. But losses from the business can also carry over onto the 1040 island, reducing your own personal tax burden. While this sounds juicy, be careful because you can only deduct losses up to the basis in your stock. If you have invested $10,000 in your S corporation and your S corporation takes a $20,000 loss, you can only deduct $10,000 of losses. See your tax professional about what are called carrybacks and carryforwards and make sure you find ways to maximize your losses. Another note in losses. To take losses against other income, you must be a material participant in the business. You can be a sole owner of an S corporation. Unlike a partnership, you must have 2 people in order to be called a partnership, but an S corporation can have 1 owner. As an officer, you must pay yourself a salary, and you must give yourself a W-2 from the corporation. Your W-2 needs to be a reasonable salary for your industry. Even though you are an officer, you are still considered an employee of your corporation. Keep in mind also that S corporations have very specific rules on fringe benefits for officers. You must have board meetings and record those meetings even if your S corporation is closely held with family members. If you don't file your Form 2553 to be an S corporation, you'll be considered a C corporation, which leads us nicely into a discussion of C corporations. A corporation files tax return 1120, so we'll call our C corporation island the 1120 island. The profits and losses stay in the corporation. So, if your corporation loses money, you can't carry those losses against your personal income. Those profits and losses stay in the corporation. If you are working in your corporation, you must also run payroll on yourself because you are considered an employee within your corporation. A C corporation doesn't have to be a really big entity. You can be a one-person C corporation. A regular C Corp has its own tax tables. The first $50,000 of income is taxed at 15%, but the percentage goes up as income increases. A C corporation files an 1120 with no K-1 needed as it pays its own tax as well as its own estimated taxes. The 1120 is due on March 15th of each year. A word about LLCs, which stands for Limited Liability Company. Of the entities, sole proprietorship, partnership, or an S-corporation can also be classified as a limited liability company, or LLC. This entity status is recognized on the state level. Ask your accountant and attorney whether an LLC makes sense for you. If you select an LLC, you still need to know if you are going to be filing as a sole proprietorship, partnership, or as an S-corporation. If you elect an LLC, you will be required to fill out IRS Form 8832 to let the IRS know whether you are a sole proprietor or a partnership. That's right! You can't file for an LLC and be a regular C corporation. Also keep in mind, it is really easy to move up the scale from a smaller entity to a bigger entity, but it is difficult and usually has tax consequences to move from a bigger entity down to a smaller entity. How about a quick review? Some people choose a sole proprietorship because it is easy, and if they don't need investors, the filing of the tax return is inexpensive. But remember, you might still have to notify your state and local agencies that you have started a business. One of the most complex topics we have covered is what you will hear in the world as flow-through entity. A partnership and an S-corporation are considered to be flow-through entity because those entities pay taxes through the individual. The profit and loss car drives from the 1120S and 1065 island onto the K1 bridge over to your personal island, the 1040 island. And those islands, the 1120S and the 1065, don't pay taxes on income. Remember the islands, bridges, and cars to help this stick with you. This catches a great many people by surprise, so be sure to pay attention to your profit and loss statements. Instead, the owners of S-corporations and partnership each file a Schedule K1, which they use in filing their personal returns. Business income or loss is thus combined with all other personal income and is taxed on the level of the individual. You should check with your state agencies to make sure that you meet the state requirements to start a partnership. The tax law for partnerships is the most complicated of all the entities, so I'm going to stop there and encourage you to seek individualized help. An S-corporation is required to file their Form 2553 within 2 months and 15 days of incorporating to let the IRS know that an S election has been made. S stands for small corporation because you can only have 100 shareholders and you can only offer one kind of stock. A C corporation is a separate entity that can be used if you would like to have many different kinds of investors or if you plan on taking advantage of fringe benefits. A C corporation offers a great deal of flexibility for kinds of stocks you might want to offer. Keep in mind that a C corporation is more expensive to run and is therefore a decision that should not be made without some additional professional help. Wow, that's a lot to cover. But remember, there's not one size that fits all. But there certainly is a match for you that makes the most sense. Thank you for visiting DeRiga University. I'm Julie DeRiga, and my co-host Dan Newton and I are so excited that you decide to join us for this class. Remember, there are many wonderful CPAs, accountants, and attorneys who would love to help you walk through this information in more detail. I recommend seeking professional advice on this very complex matter, as the purpose of this class is to give you a general overview of your different choices of entity structures. Thank you again for coming, and I wish you all the best in all of your future endeavors.